Most people think jumping into a higher tax bracket means the government takes more from everything you earn. That's not how it works. Today, I'm breaking down every single tax that affects your money, how they actually work, and the hidden ways they grow without anyone voting on it. Starting with the one you see on every paycheck: income tax. Here's the thing about income tax that nobody seems to understand. It works in layers. The government doesn't look at your salary and slap one rate on the whole thing. They slice it up. In 2025, the first $17,000 you earn gets taxed at 10%. The next chunk up to $64,850 gets taxed at 12%. Then 22% up to $103,350. Each dollar only gets taxed at the rate of the bracket it sits in. So no, getting a raise will never make you take home less money. That's not a thing. Now here's where it gets sneaky. Your employer withholds your estimated tax and sends it off before you ever see it. Convenient, sure, but it means you never feel the full weight of what's being taken. And then there's bracket creep. When inflation pushes your wages up but the tax thresholds don't move at the same rate, you get shoved into a higher bracket without earning a single extra dollar in real purchasing power. It's a tax hike that requires zero votes, zero announcements, zero accountability. Income tax started as a temporary wartime measure in 1861, emergency funding for the Civil War. Turns out temporary is a flexible word when you're a government that likes revenue, but if income tax feels like it takes a lot from your paycheck, wait until you see what happens when you try to sell something for a profit. Capital gains tax. Here's a tax that technically applies to everyone who sells an asset for profit, but functionally exists as one of the most generous loopholes in the entire system for people who are already rich. Capital gains tax is simple on the surface. You buy something, whether that's stocks, property, a business, whatever, and if you sell it for more than you paid, you owe tax on the profit. But here's the thing. You only owe that tax when you actually sell. If your stock portfolio doubles in value when you just sit there, you owe nothing. The government only comes knocking when you realize the gain. Hold an asset for a year or less and you're paying up to 37%, same as ordinary income. Hold it longer than a year and you get the preferential long-term rate, which caps out at 20% plus a potential 3.8% surcharge for high earners. But here's where it gets genuinely absurd. If you never sell, you never pay. And if you hold those assets until you die, your heirs inherit them at the current market value. All that accumulated gain, decades of untaxed growth, just vanishes from the tax base permanently. Gone. A worker gets taxed the moment their paycheck hits. A billionaire can accumulate unrealized gains for an entire lifetime and pass them on without a single dollar going to capital gains tax. I don't know what to tell you. There are carve-outs too. Sell your primary residence and up to $250,000 in gains is excluded, $500,000 if married. Opportunity zone investments held for 10 years can dodge capital gains entirely, but none of that compares to the step up at death. That single provision is how dynastic wealth compounds across generations with minimal tax friction, and it's completely legal. Which brings us to the entity that's supposed to be paying its fair share on all those corporate profits. Corporation tax. Here's the thing about corporation tax. Politicians love it. We're going to make big business pay their fair share. Sounds great, sounds progressive, sounds like it has zero effect on you, the regular person watching this. Turns out, corporation tax starts simple enough. You take a company's accounting profit, adjust it for depreciation and non-deductible expenses, and tax what's left. The corporation writes the check. End of story, except it's not even close to the end of the story. Because here's where it gets uncomfortable. Empirical research consistently shows that the economic burden lands heavily on people who never see it on a bill. Studies estimate that somewhere between 30 and 70% of the corporate tax burden falls on workers through lower wages. One study found that for every dollar increase in corporate tax, worker wages dropped by 49 cents, and it gets worse. A 2017 study found that this burden doesn't land evenly. It falls disproportionately on low-skilled workers, younger workers, and female workers. The people with the least bargaining power absorb the most pain from a tax that was sold as targeting boardrooms and shareholders. But wait, workers aren't the only ones catching strays. Research shows a portion gets passed straight through to consumers, particularly on lower-priced items, the exact items low-income households buy most. So you've got a tax that sounds progressive but may actually function regressively, a hidden tax on workers and shoppers who never see a line item for it, which is, not ideal. But if you think a hidden tax on your wages is bad, wait until you see the one that's printed right there on your receipt. Sales tax and VAT, NERS. Two systems, same economic result, completely different psychological experience for the person paying. In the United States, sales tax hits once at the final point of sale, administered at the state and local level. Thousands of different jurisdictions, all with their own rates and rules. 5 states don't even have a state sales tax. The whole thing is a patchwork nightmare for businesses, but conceptually simple for consumers. You see the tax, you feel the tax, you get mildly annoyed by the tax. Every single time .vat, which most of the world uses, is a completely different animal. It's applied at every stage of production and distribution, manufacturer to wholesaler, wholesaler to retailer, retailer to you. But here's the trick. Businesses reclaim the VAT they paid on inputs and only remit the difference to the government. The full economic burden still lands on the final consumer, but no single business in the chain feels like they're shouldering the whole thing. The global average standard VAT rate sits around 15 to 16%. That's a massive tax. But in most VAT countries, prices are quoted tax inclusive. You see a price, you pay that price, and you barely register that a significant chunk just went to the government. Americans, meanwhile, see a price, get excited, then watch it climate check out like a betrayal. Same tax burden. Radically different emotional response. VAT is one of the most efficient revenue machines ever designed precisely because no single person feels the full weight. It raises enormous sums with minimal public resistance, which is, exactly what a government wants from a tax. But if you think invisible taxes are sneaky, wait until we talk about the one tax you literally cannot escape just by owning a building. Property tax. Here's the thing about property tax. It is the only tax that will make a grown adult scream at a local government meeting. And the reason is simple, you actually see the bill. Most taxes are hidden, they're withheld from your paycheck before you ever touch the money, or they're baked into the price of something you're already buying. Property tax shows up in your mailbox with a specific dollar amount and your name on it. That psychological difference is enormous. The calculation itself is straightforward. Your local county appraises the value of your property, multiplies it by the combined tax rates from your school district, city, and county, and sends you the total. That money funds schools, roads, fire departments, basically everything local that keeps your neighborhood from descending into chaos. Now here's why economists quietly love this tax, even though voters despise it. You cannot hide a building. You can't move it to the Cayman Islands. You can't restructure it through a shell company in Delaware. It just sits there, being taxable, which makes it one of the most efficient and hardest to dodge tax bases in existence. But here's where it gets complicated. When your local housing market explodes and your home value jumps 40% in 3 years, your tax bill jumps with it, even if your local government never touched the rate. Homeowners see a massive increase and assume officials raised their taxes when really the market did. And one more thing nobody talks about. Renters absolutely pay property tax, they just don't know it. Landlords receive the bill, factor it into rent, and pass the cost straight through. Every renter is subsidizing property tax without ever seeing a line item. But at least property tax only comes for you while you're alive. Unlike what happens to your wealth after you die. Inheritance tax. Inheritance tax is the most politically hated tax that almost nobody actually pays, and I can prove it. Here's how it works. When someone dies, the government can levy a tax on the wealth they pass on. Some systems tax the entire estate before it gets divided up. Others tax individual heirs on what they receive. Either way, it's a tax on dead people's money, which is why critics call it the death tax, and voters lose their minds over it. But here's the thing. The exclusion amounts are so high that the vast majority of estates pass completely tax-free. We're talking a tiny fraction of deaths triggering any federal estate tax at all. Most families will never come within shouting distance of the threshold, and it gets better. Remember that step up in basis from capital gains? When someone dies, their assets get their cost basis reset to current market value. So if grandma bought stock for $10,000 and it's worth $500,000 when she dies, those gains just vanish. For estates below the exclusion, that wealth escapes both income tax and estate tax. Total tax-free intergenerational transfer, which is, not ideal if you care about tax fairness. Now, for estates that are large enough to be taxable, the nominal rates look scary, but sophisticated estate planning with trusts, gifting strategies, and business reliefs narrows the effective coverage even further. Planners have exploited every gap between gift tax and estate tax exclusions ruthlessly for decades, so you end up with this paradox. A tax that dominates political campaigns and generates furious debate, yet barely touches most wealth transfers. People fear a tax they will statistically never pay. But if you think the gap between perception and reality is wild with inheritance tax, wait until you see how payroll tax quietly takes more from your paycheck than almost any other levy on this list. Payroll tax. Here's something that might genuinely annoy you. For most working people, payroll tax is the single largest tax they pay, not income tax, payroll tax, and half of it is completely invisible. In the US, Social Security is funded by a 6.2% tax on your wages, plus another 6.2% paid by your employer. That's 12.4% of your labor being siphoned off before you see a penny. If you're self-employed, you pay the full 12.4% yourself, which is a fun discovery for freelancers around April. But here's the trick: that employer half never shows up on your pay stub. Your employer pays it on top of your salary, which means your salary is already reduced to account for it. Economists broadly agree that the employer portion comes out of wages that would otherwise be offered to you. You're paying all 12.4%. You just don't know it. Now, here's where it gets regressive. The taxable maximum for 2025 is $176,100. Every dollar above that, zero Social Security tax. Someone earning $176,100 and someone earning $5 million pay the exact same dollar amount. And despite being called contributions, the system is pay-as-you-go. Your money funds current retirees. In 2023, total Social Security income hit $1.351 trillion, and 91% of that came directly from payroll tax. Your paycheck, funding someone else's benefits right now. The UK pulled the same move with national insurance. It's administered by the same agency as income tax, but perceived as something different. Which is exactly why governments have repeatedly raised NI rates instead of income tax rates. Same economic effect, less political backlash. Brilliant packaging, but if you think the taxes you can't see on your pay stub are sneaky, wait until you hear about the ones you can't see anywhere at all. Stealth taxes. Every tax we've talked about so far has one thing in common. You can see it, it's on your pay stub, your receipt, your property bill. But the most effective tax in history is the one you never even notice, and governments have gotten very, very good at collecting those. The term stealth tax was popularized in UK politics in the 1990s, but the mechanics have been running for decades. Here's how it works. Inflation pushes your nominal wages up, your pay rise looks nice on paper, but the tax brackets haven't moved. So now a larger chunk of your income sits in a higher band. You're paying more tax without earning more money in any real sense. Nobody voted on this. No politician stood at a podium and said we're raising taxes. It just happened automatically. Every single year, this is called bracket creep, and it's one of the quietest revenue generators in modern government, but it doesn't stop there. Most countries tax nominal capital gains without adjusting for inflation, meaning inflation itself creates taxable income that doesn't represent any actual increase in your wealth. You made $0 real dollars, and the government still wants a cut. Then there are sin taxes: tobacco, alcohol, fuel, sugary drinks, introduced under public health justification at low rates, and then they just keep growing. And here's the thing nobody mentions: sin taxes are regressive. Lower income households spend a higher percentage of their income on these goods. They get hit hardest. And when governments want to raise a charge without calling it a tax, they just call it a fee or a levy, which is, not ideal. The cumulative mechanism is what makes this devastating. Non-index thresholds plus inflation, plus expanding excise bases, plus quiet technical adjustments, year after year, no announcement, no vote, just thousands of tiny invisible adjustments compounding until you're paying substantially more and nobody ever asks your permission. That's the real trick. The most effective tax isn't the one with the highest rate, it's the one you never see coming. If you enjoyed this video and want to see more, click the video on the screen now.